Hey, good afternoon, everyone. My name is John Jiminod, EVP of Production here at Angel Oak Mortgage Solutions. We'll get started here in about a minute. We'll let everyone log in. Today, we're going to talk about our debt service coverage ratio program and focus on some short-term rentals. And we'll share with you a couple of enhancements we rolled out within the last few weeks. So I'll introduce our subject matter experts here in a minute. And just a couple of housekeeping. This is being recorded. Everything we're doing is on our website, so there's no PowerPoint. We will get a recording of this out to you by end of day tomorrow. And if we don't get to any of your questions today, we will have your account executive reach out to you. So look forward. Hopefully everyone's having a great March, great first quarter. And we'll get started here in about 30 seconds. See everyone's still logging in. Appreciate everyone attending. Hopefully the weather is changing in your neck of the woods. I'm here in Dallas, Texas, and it's going to be in the mid 80s today. So lovely. Okay, people still logging in. Give it about another 30 seconds. Appreciate everyone joining us, and hopefully everyone's excited about the rest of 2025. And I know we are. So, all right, let's get started here. Again, my name is John Jiminod, EVP of Production here at Angel Oak Mortgage Solutions. I've been with Angel Oak for it'll be 11 years in June. And today we're going to talk about our debt service coverage ratio and short-term rentals. I'm going to introduce our two subject matter experts. I'll start with Annie. Annie, please introduce yourself.
Hey, everybody. Good morning, good afternoon, depending on where you're joining us at. I am coming to you guys live from beautiful Seattle, Washington, and we actually have the sun out today. So you might actually see it glaring in my face a little bit because we're not quite sure what to do when the sun comes out here. But I'm excited to present for you guys today. Hope you learn more about the DSCR loans. I've been a part of the Angel Oak family now going on 10 years. And so we love what we do, and I'm excited to share with you and answer your questions today.
Yeah, I always say if I'm a loan officer, my day just gets brighter, right? Just because of her. And we were all lucky enough to see each other at our sales conference beginning of last month. So we're 30 days off of a great, rallying cry, and just it was just great to see each other. And Chris, it was great seeing you there. Please introduce yourself.
Great to see you too. Chris Taylor. I live in Denver, where we do have a lot of sunshine. It's actually finally warming up here, so that's good. Excited to present this to you today, and been with Angel Oak 9 years now. So yeah. It's been an amazing journey.
Yeah, Chris, it's always been fun. I don't know why, but we've always gravitated towards each other at our sales conferences. It's like having old friends on the call today. So look forward to educating everyone, and hopefully we can help you grow your business with the debt service coverage ratio loans, because they are great loans, and investors continue to invest in the real estate market in the U.S. So before we get started, we're going to do a poll question. Who's originated a debt service coverage ratio in the last 12 months? So hopefully while that's going on, and I know everyone thinks big corporations are buying, a lot of these properties across the U.S. It's still about 70% to 75% of the homes owned or investment homes are owned by individuals, like hopefully all of you on this call and all of your customers that you're going to reach out to after this. So let's see what the poll. Did we not launch the poll? Let's launch the poll now. So is the poll out there? Sorry, guys. Okay. Sorry. So let's back up here a little bit. We just launched the poll. If you can vote if you've originated a debt service coverage ratio loan in the last 12 months. And I'm going to probably put something marketing. Today we're going to talk about how to market to these borrowers. We're going to talk about who these borrowers are. We're going to take you through our quick quote and our most underutilized part of our website is our marketing portal. So, all right. So, wow, 53%. I think that's the first time, Chris and Andy, you guys have done these enough. That's the first time we've had more people say yes, they've originated a debt service coverage ratio loan in the last 12 months, which is great. So hopefully we can give you some tips and tricks on how to get more of this business, because I'm sure all of you will agree these are great loans. So Annie's going to get us kicked off here. Hopefully everyone can see here. Hopefully the screen size. Annie or Chris, please tell me if I need to enlarge this a little bit. But oh, hold on. Annie, give us some highlights of the debt service coverage ratio.
Perfect. So my most favorite thing about the DSCR loan is, first thing is there is going to be no employment or income information on the 1003. So the qualifying of this loan is completely based off the cash flow of the subject property against the mortgage. Now, when it comes to specifics we can do loans up to $3 million. Max is going to be 70% LTV, but it does start at a 680 credit score. So these loans do start with a 680 credit score. We can go up to 75% LTV. Max we can go up to is an 85% LTV. Now, I will be honest with everybody on this call, because, you know, especially a lot with the customers that I work with, I always tell them, okay, this is what I'm seeing in the marketplace, especially if you're working with a single family residence. A lot of the deals I'm doing right now are going to be between 70 to 75% LTV, and that is because of where the interest rates lie in regards to the mortgage payments and in regards to the rent. So at the 75% LTV, we do allow you to go down to a 0.8 DSCR. We're at a 70% LTV. It allows us to utilize the no DSCR option. So for a lot of purchases right now, especially with a single family residence, this is where they are falling into. I did close a fourplex last month where we were actually able to go up to 80% LTV, and we were able to DCR at that one minimum at that 80% LTV. So if you're doing a multiplex property, you do have a higher chance of the loan meeting that one DSCR that we need for the 80 or 85% LTV, regardless to the single family where I'm seeing a lot of that 70 to 75%. And so that's the different areas comparison to the DSCR. Now, what's also great about this loan is we do allow you to close in an LLC, and there's no additional fees for closing in that LLC. So we can close in that LLC, S Corp, C Corp, or even a revocable trust. Especially let your account executive know at the beginning if they do want to close in that LLC, so we can review that paperwork up front. Because we do have a unique guideline that everybody in the LLC must be on the loan. So we want to verify that early on. Also, we do, another caveat is they cannot be a first-time home buyer on this loan. And the reason why is we want to prevent any type of occupancy risk. I get this, question all the time. But non-QM, we do have to look at ATR. We do have to fall within those guidelines as well. So if we feel that there's going to be occupancy risk, then that's going to prevent us from doing that loan, because we would not be able to verify any ability to repay. And so we do allow, of course, citizens, non-permanent residents. We do have interest-only options, and we will qualify off the interest-only payment for that DSCR calculation. And then,
Andy, I'm sorry about that, but we're probably going to talk about it because we're going to get that question, but you just hit on a huge point. Interest only and qualifying them off the interest only payment is, I think is really, really, really huge. So sorry.
Mm-hmm. No, it is. It is huge, and it does allow us to utilize a higher LTV when qualifying. So that is a big thing to remember when we're doing that pre-qualification process. And another thing I also do want to point out during the pre-qual with your AE, especially for doing a purchase on a single family residence, it's always hard to really know, okay, what is that market rate going to come in at on the appraisal? And so we're always doing our best, trying to do the best guesstimate we can. And what I really enjoy doing, this is kind of like a little cheat that I have come up with that I work with my loan officers, is I always go into Zillow. And then I see what is listed for rent in that community that is going to be like our subject property. And I have found this to be extremely effective. When we go in and we look, we usually come in within about, I would say, $100 to $200 of what the market rent is on the appraisal. So for everybody on this call today, that is a great way, especially when you're working with your borrower up front, to see, because we've all had the scenario where the real estate comes to us and the agent says, oh, this is going to rent out for $4,500, $5,000. And then I look in the area and I'm seeing $3,000 to $3,500. So I do think in some instances, agents can get a little excited about the rate, but then we need to bring the borrower back down to reality and say, okay, this is what I'm seeing. This is the current expectation. So that's what I have found to be very effective in trying to determine what that can be during the pre-qual phase on some of these purchases. And then, of course, we do allow up to 6% seller credit. And then on top, another huge one. And then we just changed our guidelines. So these are some pretty awesome guidelines. We do allow gift funds. Borrower must bring in 10%, but if we have a non-borrowing spouse, that is no longer considered gift funds. Now we qualify on, if we have two borrowers, we now will qualify on the higher earning, higher score between the two. So we used to qualify on the lower score. Now we will qualify on the higher score. And then on top of that, we just changed our reserves. So we used to allow or ask for 6 months reserves, and now we ask for 3 months reserves across the board, unless it's a foreign national loan, which we can get into later if we have time. And then on top of that, we increased business purpose loans. So before we used to do that in only 12 states, and now we do that in 21. And you can see on the website the states where it is highlighted that we allow the business purpose loans now.
We can end it right now, Amy. You did a great job. It's really, you hit on a lot of recent enhancements, and for those of you who close loans with Angel Loan, we're always enhancing our programs because we have 12 years of reporting, and that we know how these loans perform. And believe it or not, I believe these debt service coverage ratios perform better than a lot of other loans out there in the process. So Chris, we're going to bring you now into the call. Talk about, Annie mentioned about, no income on these loans. What do you, and Annie touched on a lot of great points, and I've got some notes here that I want to continue to talk about. But Chris, talk about what you want to see or not see on a 1003, and then talk about the credit report and what you want to see on the credit report.
Okay. Well, first, I just want to say that the DSCR program has really evolved. The 9 years I've been here, traditionally it's been like 70% of my business has been a bank statement loan, has been the scenario requests I get every day, and now it's kind of almost flip-flopped where most of the calls I get today are on a DSCR loan, and even the pre-quals I get are DSCR. There's just a lot of talk. The product is really expanded. It allows a lot more than it used to. So it's become just a really, really popular program. And the rates have been pretty close to what you get on a Fannie Freddie loan today, which is I've never seen in my entire career something like that. And it's just amazing to see us compare to a Fannie Freddie loan for an investment program. So all of that has just made it so popular. Our job really is to help you, guide you through the process, and the more information we can get up front, it's really important so we can help structure your loan properly. So on the 1003, we really, really want as much information as we can get, except for the employment and the income, because we don't look at debt to income ratio. We're really looking at the cash flow of the subject property. What's really important is to know a lot about the subject property we're looking to make the loan on. That in itself has become, a big thing, whether it's a 4-unit or whether it's a condotel, maybe a small house in a ski area that's semi-rural. We really try to deep dive on that property so we can understand more about it. Also, the projected rent, how we're going to qualify the loan, whether it's a DSCR ratio of 1 or better. Some cases now, we have 3 tiers. We can go to 0.8 or we can go to no ratio. So we have a lot of flexibility, and it really helps us to have a really accurate 1003. The other thing that I always get a question about, well, should I put all the properties or should the borrower put all the properties they own on the 1003? And I say yes, because even if they're free and clear, we just need to know if there's a lien on the property, because we're going to ask for a credit history if there is one. So it's really important that we get all the properties listed on the 1003. Having said that, a lot of borrowers own commercial properties. Those are usually not considered. We don't look at the credit history on those, so we usually just say to leave those off. But having a good real estate schedule on the 1003, the assets that they have or how they're going to qualify with their assets is really important to also know. And then that kind of leads to the credit. We just recently announced that we allow the highest middle score of, the 2 borrowers on the loan. If there are 2 borrowers, that's really big plus. But traditionally, we want to see 3 trade lines for 12 months or 2 for 24. Our credit scores can go as low as 680, and that's been really helpful in some cases. And then we do want to see typically that there's been a mortgage on the report, primarily on their primary residence. So mortgage history in general is really, really important. We want to see usually a pretty clean mortgage history overall. And it has to be a good credit quality borrower.
Yeah, Chris, and Annie mentioned it, our average score on this borrower is like a 734, and our average LTV, Annie mentioned this earlier, is usually in the 70s. So these are really, really good borrowers. So just a couple of questions that are already coming in here. One, yes, this is being recorded. We will get this out to you before end of day tomorrow. And if we don't get to all your questions, we will have your account executive reach out to you probably sometime today. So a couple of other questions coming in. Annie, you mentioned you can close in an LLC. I believe it's John's asking, does this still report to their personal credit?
Great question, John.
Yep.
And yes, so it will report on their personal credit report, and they will also need to sign the note. So title only is what we allow to close in that LLC. So definitely let your borrowers know that up front, because I do find that some of the investors out there want an option where it is not reporting on the credit report. So that's something to be very particular about.
So you answered John, and you answered Ray's question. So thank you. Let's go to Chris. Annie mentioned earlier one of the enhancements was 3 months reserves. Is that on all their properties, or is it just on the subject property?
Yeah, it's great because it's only on the subject property. So that's really important.
Yeah. So between the 6% seller concessions and the 3 months reserves and qualifying off of interest, it's really we've got other AEs that call these a done deal. I mean, because no matter what, we're going to get them done. And Andy, I brought up here on the screen about the debt service coverage ratio, and so talk a little bit more on that. And the thing I love about what our account executives do at Angel Oak, Andy, and you brought it up earlier about you'll go into Zillow and look at the somewhat closer to the rent, because everyone thinks their place is going to rent for probably X amount higher than what they think. But you and Chris and all our other account executives across the country, they're doing a pre-qual. And we're going to show everyone later on how to get that pre-qual to us. But that's really important. So talk about the debt service coverage ratio and some other things that you do when you do your pre-quals, please.
Perfect. So depending on what type of pre-qual we're doing. So obviously if we're doing a purchase, then I covered how I go into Zillow and we do the best job to estimate what that market rent is going to come in at. Now, if we're doing a refinance, then we actually have the option. We're going to either use the rent that they're actually receiving, and so then we have the ability to go in and show the 3 months worth of rent. That's if the market rent were to come in any less than what they're actually receiving in that rent. So it's very important, if we're doing that refinance, to be able to do that. At 65% LTV, we actually have a no DSCR option on that cash out refinance. So if that mortgage payment is going to be a lot more than the rent that they're receiving, that's a great option. And I'm actually seeing a lot of that right now in the marketplace where investors are going in and they are taking out that existing equity. So we're okay. Like I've had DSCR loans come in at 0.46. Obviously we're utilizing the DSCR often and we're doing that cash out refinance. Now we also did have a guideline change where now we allow the use of AirDNA. And so now we are no longer looking at the market score on that or how many days it's been rented out. We just go flat out off of that projected rent. So if we're working with a short-term rental, we can go in, pull that AirDNA while we're doing the pre-qual, and we use 100% of that projected market rent. So if that projected market rent is $120,000 a year, let's say we're working on a huge fancy loan, then we're going to, divide it by 12, and that's what we're going to use. If we are working with a short-term rental and they want to do a cash-out refinance, then we just need to look at what they have been receiving through like either Airbnb or VRBO for the past 12 months, and then we will divide that by 12, and then that will also show us what they have been receiving that we can use for the DSCR calculation. So we have many different ways we can qualify. In fact, I just had one come in, a delayed financing, where I was able to get an exception to use the AirDNA up to 3 months. The borrower had gone in, they purchased it with cash, and so they're using it as a short-term rental. So I was able to get the okay from management to use the AirDNA for that. So when we're able to do these kind of things up front, it just helps confirm for the borrower. And lots of times, especially when I am going into Zillow, I'll have these come in at 75 to 80% LTV, and I'll get on the phone with my loan officer and I'll have the conversation with them of, look, especially if it's a purchase, like I can approve it at 75% LTV. This is what I'm seeing, on Zillow. This is what I'm seeing in the marketplace. Please confirm with your borrower, depending on what the final market rent is on the appraisal, that they can go to 70% LTV and bring in 30%. Because the last thing we want is to say you're all good at 75, you're all good at 80, and then have it come in so much lower they no longer have the funds to bring in for closing. And so I always tell everybody we'll go to the max LTV we can, but always please make sure that from what I see in the marketplace, you can bring in that amount of the down payment to always make the loan work. So that way in the end we can get it closed and everybody's happy, especially your referral partners.
Yeah, Annie, and I don't think we rely, I know a lot of people just submit loans, but you, Chris, and all our account executives across the country, we do that pre-qual up front because we really, we treasure our relationships, not only with the originator, but we cherish those relationships that originator has with their referral partners and with their borrowers. So I think having all that done up front, and I don't know, Annie, I might have missed it. Can you do on a purchase, can you do a pre-qual up front on a TBD?
Oh, of course. I do them all the time. And then on the pre-qual, it's always very important to note that as AEs, we have on the third page AE notes. And so I always put in the AE note box that this is on a TBD. The moment they have a property in mind and they go in contract, it's very important to send us over that address. So that way we can review it, make sure it qualifies, and then also on a purchase, take a look at the, the market in that area and see where we're going to land potentially on that DSCR. Do our best guess up front, so that way we can let the borrower moving into loan the feedback.
Thank you, Annie. And Chris, Kevin's asking here, they have a subject in an LLC with 2 members, greater than a 1 DSCR. Can we only go with one of the borrowers in the file and go off the higher FICO score? But Annie mentioned a recent enhancement, so go ahead, Chris.
Yeah, so anybody that's on the LLC has to be on the loan. And so that's just a requirement. And I think we allow a max of 2 or 3 members. And in that case, I think we would take the higher of the 2 scores. So that really helps. That's a huge change because many loans in the past where I've had that problem, and now we don't have to worry about that problem. So
yeah, it's really big. And Annie, you mentioned 4 units, but what's the max we will lend on right now from a unit perspective?
From a unit perspective, we'll go up to 80% LTV. So that's really big, especially when it comes up to your 4 units. And then also just to note about using the credit score of the higher of the two is I actually have a good friend that works at one of our competitors, and he texted me yesterday and he goes, do you really use the higher score now? He was like, I have a borrower with like a 690 and then the other borrower with the 760. Are you telling me you're really going to use the 760 on a DSCR loan? And I'm like, yep. He did not like that. So huge win there.
Yep. It's just, and again, Elaine is asking the correction, the higher score, right? And I'll answer this. Chris just answered it. So, yeah, we don't look at income on this. So we're not taking a primary wage earner score. We are just taking the higher of the two borrower scores. So, excuse me, we do not look at income. So therefore, again, it was just an enhancement made less than a month ago. We will take the higher score of the two individuals applying for the loan. This will be recorded. A lot of questions regarding short-term rentals. Annie, you went over it. Chris, just talk a little bit about the short-term rentals and some of the deals you may be working on. Obviously, living in Colorado, talk about some of the short-term deals that you're getting.
Yeah, so I'm getting a mixture of different types of properties. So I'll have, like, for example, that rural cabin in the mountains. We can do that as long as the acreage isn't, more than like 3 acres and it's close to a ski area, has, good rental potential. The AirDNA report is so huge because you can run a report on a place like that and we can use that income, 100% of it. Also getting, we have a lot of condo hotels. Most of the condos in the mountains are condo hotels, and we have a great condo hotel product. That's been a game changer for the DSCR loan program, and we made an enhancement to allow a minimum of 450 square feet with like a real micro kind of kitchen situation. That's really helped in the short-term rental market. There's a lot of ski areas where it might just be like a studio, for example. So we've been doing a lot of that. And then the general long-term, the other type of loan I get is sometimes a very big loan that maybe doesn't ratio 1-to-1. And we can do a no ratio deal on something like that, which has also been a huge plus for the DSCR program, where it's like a no doc loan and they can qualify. So that's been really, really huge. In general, most people are asking me one other big question. I think one advantage we have at Angel Oak is we don't require investor experience. I get asked this almost every single day. How many years or, how much experience do you need? We don't have that overlay at Angel Oak. So, typically we want them to have a primary residence. That's what we, usually look for. We do make exceptions there too, but we don't look at experience. So that's a really big plus. And we allow gift funds. So we used to never allow gift funds, but we do allow that.
Yeah, and Annie said it earlier, Chris, that we'll allow gift funds as long as they have 10% of their own funds in there. And a couple of things you hit on, Chris, that I really want to hit on. You hit on this earlier about the rates. With all the LLPAs that the conventional world's putting on investment properties, I have heard account executives tell me that our rates in some cases are even a little bit better, right? So than conventional rates for investment properties. And Annie, I'm going to ask you a question here. Someone's asked about the prepayment penalties, and can the prepayment penalties be bought out?
Great question. So we have different options on the prepay. So you can go all the way from a 1-year prepay to a 5-year prepay. And yes, that can be a difference in rate. So the shorter the prepay term, we can add that onto the rate, and the higher the rate. Now we do have an option for a no prepay. If you do want to move forward with that option, that cannot be added into the rate. That is a buyout fee that will be on the LE, and that fee is anywhere between 1 to 1.25. When we get into quick quote, we can show you how to price it out with a no prepay, and then that's going to let you know what the buyout fee is. What's also important to know with the buyout fee is every time we do that, you have to go borrower paid comp. So you also have to charge your origination fee up front. So what I'm seeing a lot of in the marketplace right now is I've only done one loan in the past year with a no prepay. Everybody's sticking to that 1 to 2 year prepay in anticipation of being able to refinance them within the next 1 to 2 years down the road.
Thank you, Annie. So Ray, hopefully that answered your question there. Chris, Tara's asking about, can the borrower utilize cash out or reserves?
Yes.
Yeah.
That's another big plus. And now with 3 months, it's, not as much cash out. So it's
Exactly. Exactly. So
we try to make it easy.
yeah, Chris and Annie, I didn't, until I'm hearing you guys talk about it, I didn't realize the recent enhancements were really how big they are. I mean, and how much we're really trying to make this process a lot easier, because these are really good borrowers. They're great loans. They perform. And it's wow. I love listening to you guys. So it's just a couple other questions here. We talked about the reserves, and I'm sorry, I'm not looking away from the camera, I'm looking at the questions coming in. I apologize. So Annie, you mentioned a little earlier about delayed financing. Chad's asking, okay, so this is a multi-part question, Annie, sorry. So you talk about delayed financing prior to 6 months, talk about cash out, and when we can use appraised values, please.
Perfect. Okay, so delayed financing, we have 2 options. If they go ahead and they get a hard money lender, then we can pay that off within the first 3 months. And what's great about the delayed financing option, they actually get the ability to get purchase rate financing and purchase LTVs. If they borrow or if they pay all cash for the property, then we can do delayed financing up to 6 months. Same thing, purchase rates, purchase LTVs. Now, after, and we do set that LTV on the delayed financing, we're between the 3 to 6 months, the LTV is going to be based off the purchase price. Now, after the 6 month period, that's where things change. We can now use the current appraised value moving forward, and then we can do a cash out. So that is, and then even though this wasn't part of the question, after 3 months on a rate term, I believe we can use the new appraised value now after 3 months on a rate term. So that's also huge. So definitely several different scenarios to help your borrower. I tend to get a lot after that 6 months, especially if we have an investor who has gone in, updated the property, and now they're ready to recoup their cash and rent it out long term.
So, thank you, Annie. Really appreciate that. Person's asking, we're not talking about foreign national today, although it does fall underneath the debt service coverage ratio. We've reduced our reserves on most of our programs to 3 months. Unfortunately, the foreign national still requires 12 months reserve. So, and then so Madeline Chris is asking, can we use short-term, and I think Annie might have answered this earlier, can we use short-term rentals for someone who doesn't have prior landlord experience? Okay, here's the question. Can we use short-term rental on a purchase versus the 1007? If you want to just clarify that, Chris, I don't think I asked the question correctly, but go have at it, buddy.
Yes, I mean, there's the application they're stating is short-term rental, and so we can use an AirDNA report on a purchase if it's going to be a short-term rental. Definitely.
We don't do it, just to answer for everyone's questions. Miguel is asking, do we do I-10 borrower? We don't do I-10 borrowers on our debt service coverage ratio, so sorry about that. Trying to get some other, Annie, this is another great question. 1031 exchanges.
Oh, perfect. Yes, we allow them.
Yep.
And so we do a 1031 exchange. I've been asked if we do a reverse 1031 exchange. I do get that questionnaire asked every now and then, and we do not do the reversed 1031 exchange, but we will do a normal 1031 exchange. Not a problem.
So Chris, you might have to look at your matrix, which is okay because things are always changing here. So Victor's asking, what's the max LTV for a cash out refinance?
75.
Yeah. So hopefully, Victor,
and by the way, up to $2 million too, if it qualifies.
Yeah. And so, Chris, you might as well go down the rest of the matrix there. How much cash in hand? Because that's the question we always get, right?
Yeah, so up to 60 LTV, I believe it's unlimited. And then over 60, we limit it to 500,000. I believe is what yeah.
Hold on, let me.
Yep, you're correct on that.
Yep.
Yeah. So that unlimited piece was another enhancement we made. It used to be capped, but now it's unlimited, which is good.
Yeah, and Chris, and Annie, a lot of these, we're seeing a lot of cash out, right, on investment properties.
Mm-hmm.
I mean, especially this time of year, it's really, and most of the time they come in multi-packs, right? Because investor wants to take cash out of a couple properties that they've had for a long time. We have seen the average home across the U.S. has appreciated, I think it's 49% since 2019. So most houses are appreciated 49%, and depending upon the market. Andy, you're up there in Seattle. Chris, you're in Colorado. I'm here in Texas. We've all probably seen larger increases over that. So, like I said, go back through your database, everyone on this call, and find out. People say, "Oh, rates are a little higher," but these investors are really adamant about continue to build on their portfolio. Although what Chris said earlier, we talk about this like it's, for an experienced investor. This is also for that first-time investor. And Annie, you touched on this, so I really want to make sure, because part of the subject of this webinar was debt service coverage ratio and short-term rentals. And both you and Chris have said this a couple times. We use 100. We don't take 75%. Talk about it, Annie. About using the 100%.
Yes, we will use 100% of the projected income on that AirDNA. So it's super easy during the pre-qual process. I believe that even on AirDNA, they allow your first 5 polls for free, where they have a trial program where you could sign up for that. And even just scrolling through the AirDNA, you have a pretty good idea of what that income will be. So super helpful. It doesn't matter what the 1007 is. Even with the short-term rentals and using the AirDNA, we will still require that, because our investors need to see that information, but it does not come into play at all. So during the pre-qual phase, we have that DSCR set off of that AirDNA, and there's absolutely no worries down the road.
Yeah, that's huge, and the account executives will look at that with you and for you. Chris, Carrie's asking, how quickly can we close these loans?
I mean, they're closing really fast. Keep in mind, we don't have to do a CD. So, that cuts 3 days off. Yeah, we don't have a rescission period. That's another, a couple of days right there. So, but, they go quickly. We're not calculating debt to income and verifying employment and all that stuff that you typically do on a loan. It's really, get the appraisal in, and usually you're closing very, very fast as soon as that appraisal comes in. It's one of the fastest loans you can close in this business. So they go really fast.
Yeah, hey, Annie, Chris, can you guys hear me?
Yeah.
Okay. I just Moses just sent me text saying he couldn't hear me. So
It's spotty on my end a little bit.
Okay. Another question here, and I understand we're getting a lot of these repeat questions because we've made a lot of enhancements here. So, Annie, talk about again the minimum. Nicholas is asking, is there a minimum credit score on the borrower, and with the lower score that's not being used to qualify? So basically, Nicholas is asking, what's the lowest score we will use on our debt service coverage?
Okay, so the lowest score we can use is a 680, and that we can go up to 75% LTV. And with the 680 and that 75% LTV, we do need to meet the requirements of a 1 DSCR. In order to utilize the 0.8 DSCR or the no DSCR option, then we need a 720 credit score at 70% LTV. are actually a 700 credit score. And then at 75% LTV, we can go to that 0.80, and then we can also go to that no DSCR at that 65% LTV. And so, yeah, so for example, if we have two borrowers on the loan, let's say one has a 690 and the other one has a 760, we will now use that 760 score in credit in qualifying. So it's a huge one for you because the pricing is going to be a lot better. It allows us to utilize a lower DSCR and higher LTV. So huge win for our LOs that do business with us on that.
Yeah, thank you, Annie. And then Chris, talk about the types of borrowers. Like and I'll highlight it here on the screen, but you know, we will lend to obviously U.S. citizens and take it from there, Chris.
Sure. We can obviously do a U.S. citizen, a permanent resident alien. We now allow non-permanent resident alien, which we never had before, and that's really, really important. And a foreign national. And keep in mind, a foreign national is somebody that lives outside of the United States purchasing a DSCR investment property in the United States. So that's really important too.
Yeah.
And help.
Go ahead, Chris. I didn't mean to.
Yeah, I would just say the foreign national, again, I find here in Colorado, it's people buying maybe a property up in those ski areas, or maybe something for their kids that are going to college. Has been probably the two types of loans I've seen on the foreign national side.
Yeah, and HL is asking, Annie, I'll throw this out to you. Is Angel Oak licensed in Hawaii?
Great question. We are licensed in Hawaii. And so you do have to be licensed in Hawaii as well. We have a wonderful AE out there that you're going to be able to work with. His name is Brandon. So you're going to enjoy working with him and closing your Hawaii loans.
And we got to meet Brandon at the sales conference, which was awesome.
Mm-hmm.
And Chris, you touched on this earlier. Karen's asking about, do you leave all the job and income information off the app?
Yes. Again, it's not we don't look at employment or DTI income at all. It all boils down to the subject properties cash flow. That's all we look at. So you can remove everything for employment. It's not, we don't want to see it on the 1003.
Yeah.
Also, I just give a plug for the no ratio program. It used to be we always had to wait till the appraisal came in for the ratio. That's a good backstop if you have a lot of equity, knowing that your deal is going to qualify no matter what.
Yeah, and this almost comes in perfect with Regina saying you guys are providing a great picture for us to bring in front of our agents and clients. So thank you, Annie. Thank you, Chris. I appreciate that. So guys, let's pivot here a little bit. You know, and there's a lot of great questions coming in here. We're not going to be able to get to all of them. We're about 15 minutes. So Chris, take us through how, you know, we talked about a prequel and how great you guys are doing the work up front. I mean, and you do, and I'm not trying to blow smoke to both Andy and Chris. They are great. They do all this heavy lifting for you up front, so you, your borrower, your referral partner can just, you know, breeze through the process. So Chris, I'm going to go back to the homepage, and you know, a couple questions here come in about rate. So let's talk to everyone about how do I look for rates, and then how do I get you a pre-qual?
Yes. So again, you know, we really like to be involved in this process as AEs. It's really important. So we've given you some tools to help with that. The first one is our non-QM quick quote. Remember, when you go into our quick quote, our pricer, you do not have to log in. You don't need credentials. You can go, anyone off the street can go into this and price out a quick loan. So we're doing a, you know, just a quick example, $400,000, 740. We can choose the LTV 75 in this case. The state is really important because we want to know if you're licensed or not, and that'll tell us if you can do the loan outside of your state. DSCR, the income type on this is DSCR, and investment. And I think on this, we always have to choose, when you get to this point, their licensing in their state.
Sorry about that.
And then here you can see, you know, just a basic pricing, and wow, you know, 6.874, you know, that rate, you know, I don't look at conforming loan rates, but A lot of times it's even or better, you know, a little worse by hardly that much. It's very competitive.
But
So
Chris,
this,
sorry, Chris, but you're not providing income, right? You're not providing job information. With all that, look at those rates, and that's at 75%, and we would give you up to it based on the parameters we put in before or above. You could qualify for up to an 85% loan to value on this. So,
and on this screen, you can see prepay penalty. So you can choose, you can kind of give your borrower an idea what the differences in rates are between a 3, a 4, you know, a 1 year, and that kind of, you get some enhancements when the longer you have the prepay.
yeah.
So if you were to send us and this gives you some basic guidelines too of the program. If you wanted to send us a pre-approval request, what's going to happen is we're going to create like a little mini loan file, if you will. You're going to view rates and you're going to choose a rate. Keep in mind, you're not locking the rate or anything. You're just kind of choosing a rate. You'll select that option. And from this point on, you're going to upload your 3.4 file if you have it. If you don't, you can click next. And then what we really want to see basically is just answer these few questions: who you are, where you work, your NMLS number, and so forth. And you know who your AE is. And then you're going to drop in your 1003, your credit. You can drop in your 1008 as well, and then any other additional documentation. Maybe you have an appraisal, for example. You can send that to us in this prequal, and then when you hit submit, it goes right to us, and we start working on it from that point. One of the things I'll say is, in our business, a good percentage of our loans, probably 25% of them, have exceptions. You know, we're not a black and white company. So this becomes kind of a working file where I think a lot with our competitors, they just email stuff. This becomes a file where we collaborate, from me to underwriting, sometimes compliance, credit risk gets to look at this as well if we want them to help us pre-approve this file. So most of the time we just pre-approve it right away. We know it qualifies. We've done the due diligence, but sometimes we got to reach for a little bit of help from credit risk. And we know that there's one thing that we have to, like, maybe outside of our guideline, we need approval for. We get that approved. That's like written in stone in our little mini loan file here. And when the loan goes to underwriting, they see all those notes.
Yeah.
That's really important.
Chris, how long, obviously, we're not waiting for bank statement review or whatever. How long does it take you typically to review a debt service coverage ratio pre-qual?
I mean, 80% of the time I can get it done in less than an hour or so if I'm right on my desk when I'm receiving it. So
just put all the other account executives across the country under the gun. So,
yeah.
It's all good. It's all good. So Annie, Regina's asking, before we get into the marketing portal, which is a lot of fun, Regina's asking, do you use other appraisals? Which is a great question because it happens, right?
Oh, great question. It happens, especially if it's trying to go conventional and they no longer qualify. And yes, we will use a transferred appraisal. Several caveats. It must be from an ANC, and it cannot be more than 60 days old at time of submission, 90 days old and refund. And I always ask, if I'm doing a pre-qual where we do have a transferred appraisal, I always ask to see a copy of it up front just to make sure it does meet our guidelines.
Yeah, and again, I'm sure everyone on this call can appreciate the thoroughness that you, Chris, and all our other account executives have with, again, doing these pre-quals up front is really, really beneficial to you versus just submitting something to underwriting and see what happens. So I really appreciate that.
One plug I just want to give for us is that when we were at our conference, I think we talked about our average AE experience with Angel. It's been I think it's like 6 years. I've been here 9 years, Annie 10. You're getting somebody that's been in the weeds, been through all these loans. You know, you really want us to look at your loan and know everything. Please use us as a confession box. We're here to like troubleshoot the problems. So
it's funny. It's funny. I usually say that, Chris, on these webinars. Your AE is your confessional booth, right? They tell them everything up front, and they find ways to get deals done. But they're also going to tell you, that's not a deal we can do. So it's we're all on the same commission structure, right? We get paid when deals close, but I think what Chris is telling you really upfront is we will try to find ways to get that deal done, but also more importantly, we're going to tell you upfront that if we're not going to be able to get that deal done, and not every deal gets done. But so Andy, let's talk about marketing, because this is really we're really here to help you grow your pipeline. And I know 56% have closed a debt service coverage ratio in the last 12 months, but there's 44% have not. And of those 56, we really want to help you close more loans. So Andy, we serve underserved borrowers. Let's talk about an underutilized portal website.
Perfect. Okay, well, while John while he goes ahead and gets logged into the website, I'm going to share a couple of tips with you, especially with working with brokers for such a long time, since the beginning of really the non-QM marketplace, and watching them evolve their marketing over time, and really what has benefited from them. You know, in the very beginning, I had brokers that utilized a lot of email campaigns, and now a lot of them have transitioned to really utilizing Instagram and utilizing LinkedIn for their marketing. A lot of people who they target is dependent on the type of loan, but they all really target the same type of people: real estate agents. You know, with these types of loans, maybe you want to target hard money lenders for borrowers that need that out, real estate investors. And so what they've done is they've built a network, and they are constantly marketing to them. They are updating and marketing at least 2 to 3 times a week. You know, this is what I have access to. This is what I have closed loans in. And so, as we always know, resell. And so every time they do close a loan, especially like a DSCR loan or even a bank statement loan, they tell the story of why it couldn't go conventional and how they closed that loan. So not only are they staying in front of their network space, you know, almost every single day through social media, they're letting them know what they have access to, and also they're painting that picture of this is the type of scenario that closed, so that way that referral network, you know, has that in their mind. Okay, these types of loans do close, and these are the types of loans that they are closing. And so let's go ahead and jump into some of the tools. So when you first sign into the portal here, you have the marketing portal. And let's go ahead and dive into some of the flyers. So we have a bunch of flyers here for you. They are already pre-done. Cover all of our programs, but we do have some that are specifically for the DSCR program. So what you can do, you just click on it. It is interactive, so you can just upload your information, upload a photo of yourself, go ahead and download, and then you can start marketing. You know, this is handy, especially if you want to visit real estate office or other referral partners. You can leave them, you know, this flyer with your contact info. Let's see if we can get the DSCR, but if not, that's okay.
Yeah, no, so Annie, this is our temporary portal that I'm using today, so it takes a while for it to download. It shouldn't take that long for you, but and there it goes. Okay.
There we go.
But you know, I know a lot of people like, who's my account executive? So my contact information is here. This is my cell phone. Please reach out. So you know, that's my email address also there. So, and I'll also put it in the chat below here for answering questions.
Mm-hmm.
So sorry, Annie, didn't mean to.
Perfect. No problem. And then let's see if we can go back to the marketing tab.
Mm-hmm.
Perfect. And then let's go down to social media. So we do have social media posts that are ready to go for you. So that way, if you do not want to create your own social media posts, you can download these depending on, you know, which outlet you're using to market to. So like I said, social media, I've seen it grow with my brokers. It is a very powerful tool to reach out to your network. And so I would highly suggest that you do post on this a couple times a week. And then let's go to our presentations. This is where you're going to get a really big bang for your buck. We have presentations that are all ready to go for you. And so this is one of my favorite parts, is the realtor presentation. And this is really a great thing to be able to utilize. So if you are having a presentation with realtors. You can download this and you can pick and choose which slides you want to go over. Now, to help you out, we do have account executives across the country, and we love presenting along your side. As Chris said, the average account executive with Angel Oak is 6 years. So bring us into these presentations because we bring the experience and the stories that sell. We can get in front of that referral network and tell them the stories, tell them what we're seeing in the marketplace. And as we always know, that helps build trust. When they can have somebody in front of them telling about the loans we're doing, that builds trust. And plus, you're in a front of a lot of realtors. Realtors we know love investment properties. And so I can guarantee you a lot of brokers that I talk with, when they are doing these presentations and they have the AE present, they do get a lot of referrals. So this is a very powerful tool. Utilize your local AEs in your market to come in and present alongside you.
I will say too that you might end up getting one of those realtors loans themselves too, because that happens a lot.
Mm-hmm.
Yeah, Chris, I always throw this out, when we do the bank statement, the webinar, 9% of the loans we close on our bank statement program are realtors. And I would imagine it's a higher percent, but guess what? We don't know because they don't put their job or their income information on the 1003. So I would imagine it's got to be significantly higher than the 9%. And you can see by Chris and Annie. Could you imagine having Annie and Chris in front of a room of realtors talking about this underserved market? My God, you're going to go in there with so much credibility, and they're going to want to work with you. I think that a couple of different ways. We have an account executive here in Dallas, Texas, who he Googled real estate investment clubs, and he stopped counting at 20. He stopped counting at 20, and then he shared that with one of his loan officers, and that loan officer brought him to that real estate investment club, and there were investors in that real estate investment club that had never heard of a debt service coverage ratio loan.
Wow.
Yeah. So I know everyone's Googling, so we're almost done here. So, but anyway, I know we're close to the top of the hour, and Chris, I know, I love working with you. And what would you say in closing, Chris?
I think it's just a part of your business. If you're not doing these loans, it's like it opens the door to probably a third of your income, in addition to what you're making now at a minimum. Like these, and you can see we just priced out a loan. You can see how the rates now, the difference between us and a conforming loan is so low, and the limited documentation and the quick close, all of that really that gives you speed as a weapon right now in this business, and you have us as experienced AEs to guide you through that process. You can become an expert to all of your referral partners in these presentations, so we can help you, hit the ground running and start building a really good business in 2025. And now that rates are coming down a little bit, there's going to be more activity. So,
yeah, Annie. Come on, just give us a great closing, Annie.
So my favorite thing and what we always utilize, especially working with my LOs when we're doing presentations, is the ability to achieve the American dream. And that is what's so wonderful. It's why so many people want to come here is for that ability. And one way to achieve that American dream is through wealth. And you can build wealth with real estate. And so these loans just make it so much easier for everybody to acquire this type of real estate, to build their wealth, to help achieve that American dream. And so that's my why for every day waking up, being so thorough in working on these loans and helping everybody with their referral partners is where we're doing a great service out there for these borrowers and for them to have their part of the American dream.
No, Annie and Chris, you guys, it's a pleasure working with you. And, we will send out a recording of this. Now I got to take it a different level. I apologize because you guys did such a great job. So, but, this is recorded. This will be sent out before end of day tomorrow. But Annie, thank you for your time. Chris, thank you for your time. Everyone, thank you for joining us on this call. If you've closed a loan with Angel Oak, thank you very much. If you haven't, Annie and Chris are giving you a great reason to close a loan with Angel Oak. So thank you on behalf of everyone else at Angel Oak. Thank you. And everyone have a great rest of your day and continued success. Thank you.